going on, YouTube? We're going to go through Hershey's company, ticker symbol HSY. One of the reasons I'm bringing this one up is if you look right down here on the chart, you can see we put our cursor in right around that $200 range. We can see it looks like the stock is potentially breaking out from these lows that it's been hitting recently. So what we're going to do is go over some of the financials and the overall outlook of the company and see if this is a breakout worth buying or if this is just one of those fake breakouts and this thing might continue to head lower. So, company reported their earnings May 3rd, beat on top and bottom lines, actually beat on their EPS by quite a bit. $1.16 beat there. And if you come over here and look, for next quarter, we're expecting, or at least analysts are expecting, only $1.36 for EPS. So that's just a significant decrease in EPS going forward. And you can see here, we've seen 19 revisions lower in the last 19 days for their next quarterly expectations. So I'm assuming that one of the reasons why is we have cocoa prices that are sitting at, not all-time highs right now, but they are significantly elevated from where they've been. And I'm thinking what's going on is that cocoa prices had not yet impacted this business, but I think it is now starting to hit. This next quarter, we're going to start to see these cocoa prices impact the overall net incomes because the cost of goods sold is now going to increase because we have cocoa prices that are very escalated at the current time. I mean, they're lower than where they used to be here not that long ago, but still very elevated from where they've been in the past and about a double. So also in their earnings call, most of the analysts, the reporters asking these CEOs and CFOs, they've just been almost every single question was about cocoa prices, every single one of them. So I think that is obviously the biggest concern going forward with this company, at least in the short term. So obviously we know Hershey beat, or for fiscal year 24, Hershey expects net sales to increase by 2 to 3%, and they're expecting adjusted earnings per share are going to expect to be unchanged. They're expecting zero growth on EPS and almost no growth on overall revenues. And keep in mind, this company is also trading at a forward PE of 21.8. So you're expecting to grow your revenues 2 to 3% in this next year, and you're still going to be trading at a 22 times multiple, and you've seen stock price start to head up higher. That to me immediately says is potentially for a fake breakout. It could potentially run up higher into earnings, this next quarterly earnings. And once those earnings come out, we could maybe see it, hit new lows, at least in the 52-week time period. So now let's head over to our valuation spreadsheet and take a look at financials and see how this company has performed over time. Revenue, gross profit, net income, all trending up higher. Come down here to our margins. Margins are fantastic. They're holding their margins as of right now. Gross margin is 45.5%. And we come over here to net margins. Net margins hit a new all-time high in this most recent quarter, probably prior to these cocoa prices. They probably raised their prices ahead of the cocoa impact prices that they're going to see. They've probably had contracts built in place where they're only going to pay companies so much. These contracts are up. Now they got new contracts, so cocoa prices went up. So they got ahead of it, increased their prices this most recent quarter, which is probably why we see net margins all of a sudden just go up about 6%. We will likely not maintain that. We actually might even just see prices, get back down to or margins get back down to 10%, be my guess, going forward, at least for a couple quarters until cocoa prices decide to come back down. Return on invested capital, 24.5%. Got a PE ratio sitting at 20.5. So historically on the PE, this is where this company trades. I mean, it's actually on the lower end of where it typically trades. So it's kind of, with only revenue growth of 2 to 3%, you're going to start to see these PEs come in to check a little bit more than, sitting at a 21 times forward multiple there. Cash to short-term debt. Company has lots of debt, not much cash. Come down here to cash to total debts. Similar story. Lots of debt. Basically no cash. Net income to free cash flow. Company produces plenty of net income and free cash flow. We can see here's our free cash flow chart. Company does about $1.3 billion of free cash flow annually. Capital expenditures, $800 million. And also company does pay out a dividend And we can see year over year, they do increase their dividends. Also, they do have a very slight share buyback program, nothing significant yet, but we can see the share count has shrunk year over year. Not at a rapid rate, but they are shrinking. So that is good as a shareholder to see that you're not being diluted. Your shares are actually becoming more valuable the longer you hold. So overall, financials aren't terrible over here. The only thing not great is their debt to cash ratio, but everything else financially looks pretty good. Hop over into their 10Q, the most recent report, and we can take a look and run through these financials and a quarterly rate and see how things are moving. And we can see net sales are up nicely year over year. And also cost of sales are actually down year over year. So net sales are up and costs are down. So very good. Obviously, gonna have to say net sales, they probably increased their pricing to get ahead of these cocoa pricing increases. So that was very likely why we're seeing that. But going forward, it sounds like we're not going to see any more price increases. We're probably going to see a pretty big hit to our overall net income in the coming quarters. So we come down here, we do see net income is up compared to year over year, which then gives us a higher earnings per share in comparison to last year. Down to our balance sheet, company is sitting on about $520 million in cash here. And we come down here, we bring our $520 million in cash. Company's roughly got $3.5 billion in just short-term debt. So we're seeing 3.48 in short-term debts there. And there's nothing really we can strip out here. Their biggest debt contributor is actually short-term debt. And even at that rate, even if you just figure in short-term debt to minus their cash, they're still really negative. So they've got a lot of debt to pay for. Anything short-term debt is due within the next 12 months. So we're seeing that companies only got $520 million in cash and lots of debt. Historically, this is how they run their business. They operate their business on very little debt or very little cash, and their debts though continue to increase. So that is a little concerning. They've probably got to borrow more money to pay short-term debts, so they're constantly just borrowing to pay down current debts. So that's probably why we're seeing total liabilities increase and kind of maybe get a little bit out of control, especially going forward if they continue to borrow just to pay down current debts. So we come down here, we can see, actually, if you actually take a quick peek, we can see on short-term debts, we went from $720 million up to $1.3 billion in short-term debts. So we added about almost $600 million in total short-term debts, probably to pay for some stuff. And then you come down here, we can see our total long-term debt. We didn't transfer any long-term debt into short-term debts, which is where typically you see an increase to short-term debt is because some of that long-term transfers into short-term, but we're not seeing that here at all. So we know more than likely that's not where it came from, but we'll see that on the cash flow statement. But now down to the cash flows, we can see, all right, here's our net incomes. We've got stock-based compensation, very nominal, like almost no stock-based comp over here, which is pretty good to see. Only sitting at about $6 million and $19 million last year. So very good there, as a shareholder, you like to see that for sure. So overall, company has produced $569 million of cash coming in. So your cash flows. So then you minus off your capital expenditures of $213 million, leaves you about $356 million in free cash flow, or about $1.4 billion annualized at that current rate there. So we come down here to our financing activities, like I was saying on the balance sheet. Here's where we're going to see where that cash, where these issuance of debt came into play, and we can see they had a net increase in short-term debt. So they borrowed about $570 million this most recent quarter. And because they borrowed that money, that in a way appears as though that it was used to pay for the dividends and repurchase stock. We can see these two big hits to their cash that flowed out of the business. So then that leaves them with a net cash used in financing activities. Even though they borrowed money, they still were negative $221 million. So when you only have $520 million in the balance sheet, you have to borrow money to pay out these dividends and repurchase stock as well. So borrowed money just to pay out dividends and to repurchase stock doesn't look too good in my opinion. That's not something that really excites me whatsoever as a potential shareholder of this company. But overall, we can see we take our cash flows up here. Our free cash flow is $356 million. Minus that, we're left with about $118 million that we get to add to our cash balance. So beginning balance was about 402. Now we're sitting at $520 million in cash. So they added a little bit of money, but that was basically borrowed money. So now let's jump over to comps. There's one other company I think is worth comparing to, and that is Mondelez, ticker symbol MDLZ. And we can come down here and compare charts to one another and see how performances are in comparison. So you can see Mondelez produces a significant amount of revenue and gross profit compared to Hershey's. But then we come down here, we can see margins though. Hershey's has a much higher profit margin across the board. And then we come down here to free cash flows. Obviously, because Mondelez does a lot more revenue, they're going to have more free cash flow. At least they should, and they do. And that's why we see a significant difference in cash flows, but both positive cash flowing companies. But you can see PE on the PE basis here. Currently, Hershey's trades for a 26, and Mondelez is trading at 23 multiple. So could kind of tell you that. And even on the stock chart here, we can see Mondelez is near its all-time highs. Hershey's is not, and Mondelez is still kind of trading for a bit of at least a discount in comparison to what Hershey's is. And we also see growth rates down here as well. Similar growth rates, but Mondelez is trading for a much better PE. So potentially that might be a better company to invest into versus what Hershey's is doing. Even though margins aren't as good, they might be a better bang for your buck, even though they are trading what appears to be near all-time highs. So over to the calculator on Hershey's, we're looking at a pretty much valuation of $50 per share. We got multiples comparing to Mondelez MDLZ, $181.32 per share. Our price to book, 5-year average is 12.5. We're currently at about a 10. Our peg ratio is kind of off the charts, sitting at forward looking at least at a 6 peg. You come over to Graham's valuation, $139.52. And Hershey's does offer a dividend sitting at about $212 per share for dividend discount model. Then over to our DCF evaluation. Analysts have a growth rate on their free cash flow of about 3%. So I matched their 3% growth rate. And with that, we come down here. We can see our DCF price per share is about $79.64. And then we come down to Rule 72. We have 3 sources of an EPS growth rate for an average of about 5.4. We get to double our current EPS about 0.75 times. So it gives us roughly a 13 for forward forward earnings per share. And that gives us a fair value of $35.22. So for a summary, comparing all of our valuation metrics that we just went over, our calculators, that gives us a fair market value of $116.30 per share. 30% margin of safety would then be $81. Analysts have a price target of $214 per share on Hershey's. At the end of the day, we also saw the growth rate is 2 to 3% for 2024. Our forward PE is 21 with a 3% growth rate on revenues. Just doesn't look good. And then on top of it, you have cocoa prices that are very elevated, at least for the short term. And it appears as though that's going to start impacting this business this upcoming quarter. So it doesn't mean this thing isn't worth more than $116 per share. This is just based on the metrics that we have today, the numbers we have today, the growth rates we have today. So as of today's numbers and everything, it's looking at about $116 per share is what this thing is worth. Now that can change in the future if cocoa prices plummet, then this thing might be worth closer to $200 per share. We've valued this in the past. It valued at $189 per share, but that was prior to cocoa prices kind of getting out of control and before that was going to impact their margins. And now we're starting to see that, and we're starting to see revenues are slowing down, and the consumers also starting to slow down as well, so they're not spending as much money. So there's a little bit of headwinds going on with Hershey's right now before things get too much better. So that's why we're seeing probably such a low fair market value on Hershey's right now. Now over to the stock chart though here. This is the one I almost bought. I'm not going to, but I almost bought, and I would have bought it as a trade, not as a hold. But if I was to have bought it, I would have bought it probably yesterday when it was trading at like $206 per share, something like that. I would have bought it then, and then I would have tried to ride it back up. because I can see there's support at about $181 per share. It appeared as though we were gonna have a breakout and then maybe make some, at least get up halfway up through this, downward trend that we hit. So maybe like 230, 240 range was my plan for this trade. But based on after going through the financials, looking at the cocoa prices and some other things, I think this is a fake breakout where this thing might come back down, retest 180, and maybe even break through 180. I don't think this thing has the momentum in it to break through, even though we do see somewhat significant volumes on these green candles. This is also on the weekly chart too, but I don't think this is one that's going to be able to maintain momentum and get much higher than where it is now. Could be wrong, but that's my assumption. That's what I think is going to happen. I think this thing's going to get rejected, pull back into this channel, probably get back down to 180 range, and probably trade in here until its next quarterly earnings. It'll probably be in this range here. Once those quarterly earnings get reported, I got a feeling this thing might break through its channel, depending on how much is priced in, and break through its channel, and then potentially see some new 52-week lows on Hershey's. It was my assumption on this one. So that is it for Hershey's. If you found value in this video, drop a like, subscribe, and comment. We'll be back later with another stock analysis video.